Today's topic, we're going to go over journalizing. And when we learn journalizing, we obviously need to have a full understanding of the accounting equation. At this point, you should probably have a solid understanding of what's on each financial statement, the income statement, the balance sheet. And now we're going to interpret individual transactions. And what we need to do is obviously understand that assets are on the left side of the equation, liabilities, owner's equity, revenues, and expenses are on the right. And basically, at the end of the day, debit means left and credit means right. So when we say we debit an account, we're going to add a left entry, and if we credit an account, we're going to add a right entry. Overall, here are the balances of all the different accounts that we've discussed up to this point. Assets have debit balances, liabilities, owner's equity, and revenues have credit balances. And expenses, even though it's on the right side of the equation, it actually lowers owner's equity because eventually we're going to close expenses off to retained earnings, and expenses make retained earnings go down. So expenses therefore have debit balances. Alright, so up to this point, here are the different accounts we talked about for assets. We have cash, AR, prepaid, insurance, prepaid, anything prepaid, prepaid rent, supplies, inventory, land, building, equipment. There are liabilities. Notice we all have payables there, and then when we owe someone a service fee, we have unearned fees. Our owner's equity accounts up to this point, we're looking at retained earnings. Remember that is a cumulative total of all net income that has been retained back into the company, minus any dividends that have been paid out. We have common stock. And there are two sales accounts we've been talking about, or two revenue accounts, sales and fees earned. So sales is when we sell merchandise, fees earned is when we provide a service. And there are expenses, rent expense, utility expense, supplies expense, insurance expense, and don't forget about COGS, cost of goods sold. The asset, equal liability, owner's equity, those are your balance sheet accounts. Remember, those are permanent. And your temporary accounts are your revenues and expenses. Those are your income statement accounts. And remember, we're going to close those to retain earnings eventually. Alright, so let's just walk you through some transactions you could practice. You issue common stock for cash. At this point, we're acquiring common stock, so the common stock account goes up. And remember, the blue have credit balances, so when we acquire stock, common stock is going to be credited. And when we sell stock, we're going to receive cash. And so cash goes up, so cash gets debited. So here's the entry, and there's the corresponding impact. So that basically is impacting the balance sheet. Paid $18,000 for a 1-year lease on office space. So we're paying cash. So cash is going down. So we're going to credit the cash account. And what we're doing here is we're acquiring an asset, a prepaid rent. So we're acquiring an asset. That asset's going up. So we're going to debit the prepaid rent asset account, and we're paying for it with cash, which is also an asset, and that's going down, so we're going to credit that account. C, purchased office equipment. Once again, we're acquiring an asset, so the asset equipment is going up with a debit, and we're paying with cash, so cash is leaving. Cash is the easiest to understand for beginning accounting students. When you're receiving cash, your cash gets debited. When cash goes up, it gets debited, and when you're paying cash, cash is credited. Cash is going down. So there's your payment of cash, and then you're assigning a note payable to the bank, and that's a liability. And remember, liabilities, when they increase with credits because they're on the right side of the equation. All right, purchase office supplies on account. We're acquiring an asset here, so supplies is going up, and we're paying for it we're creating a liability. Since we're not paying with cash, we're creating a liability. There's accounts payable. E, sent a bill for $4,500 to a customer for services performed. So we provided a revenue here, and that revenue that we provided, that fees earned, is a service. So what we want to do is make sure that we pick the right revenue account, so services fees earned. And they're not paying us in cash, but they owe us money, and receivable is when our customers owe us money. Receive $1,000 from a customer for services to be performed next month. So we're receiving cash up front, $1,000, but we now owe them that work, and so that's a liability. And there's your unearned fees account we're going to look at. And so now we owe them that work. G, paid employees for hours worked. So we're paying them cash. Cash is going down, and we're basically incurring a wage expense here. So there's the debit to wage expense. And remember, expenses carry debit balances. So when we increase them, we are going to debit them. And there's the credit to cash. H, paid half the amount owed for the supplies and transaction. D, and remember, when we purchased those office supplies, we debited supplies and we credited the payable. Now we're paying off the payable. So we don't go back and touch the supplies account because we've already debited the amount by $750. So we're paying off half the payable, so half the payable is going down. So to make the payable go down, we need to now debit the account. And we're paying with cash, so we're crediting the cash account because the cash account is now going down. Received but did not pay the monthly telephone bill. So now we have a telephone expense, whatever you want to call that. It could be utility expense, telephone expense. So we have an expense. Now we haven't paid them, so now we owe them money, so that we've created a liability, a payable. And then the last one here, paid a dividend to owners. We're paying out cash, so cash is going down. And remember, retained earnings holds net income eventually. And so when we pay net income out to our shareholders in the form of dividend, that comes out of the retained earnings account. So remember, retained earnings has a credit balance, so to make it go down, we're going to debit it, and then we're going to pay with cash. So there's some basic kind of nice visual representation. You could kind of follow along. Pause the video, practice, see if you could write the entry down, play it, listen to the explanation, see if you understand it, and if you have any questions, always feel free to stop by. All right, thanks.